Hello, everyone, and happy Friday to our weekly webcast 26. This is Tom from MarketsFlow. It is the 25th of October, 2019, as we bring you this weekly performance for the week so far. I'm here with Adam. Adam, how are you doing?
Well, it's not raining. The air conditioning is set at the perfect temperature. The coffee is good, and it's Friday, so things could be a lot worse.
Great, thanks, Adam. That sounds very good. So let's get started. This is Webcast 26 for MarketsFlow's portfolio performance for the week ending October the 25th. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's made available. MarketsFlow is an FCA-authorized robo-advisor and digital wealth manager. We're also SEC-authorized. Your deposits are protected by the FSCS for up to $85,000. Go to marketsflow.com to learn more about our portfolio performance. You can download our mobile app on the App Store or download it on Google Play. You can sign up and start investing from £10. Before we start, I'd like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. I'd also like to just mention that towards the end, I'm going to talk a little bit about some of our new portfolios, and we'll cover those. So with that said, let's cover the important subject of how did our portfolios perform this week. So Adam, over to you.
Thanks, Tom. Well, up to now, and this is just partway through Friday with a couple of hours to go before the market closes, the high-growth portfolio is up 0.32% this week, up 7.08 since the launch of these accessible portfolios in early June. The growth portfolio is up 0.34 this week and is up 7.56 since that same launch date. As for the ISA portfolio, up 0.05 this week, and since the launch date, that's done 4.38% up.
Thank you for that, Adam. And how do they fare in terms of analyzed basis?
Well, if we were to project outwards from this 4th of June to current period, which obviously is just a little under 5 months, and if we were to suppose the same rates of return were obtained for a full 12 months, the numbers that would give us for each of those three portfolios, high growth, and ISA, are 19.3%, 20.68%, and 11.69% respectively.
Okay, thank you. They sound very good. So how has the market as a whole performed this week?
Well, measured at the same time that I measured the portfolios, the market, meaning S&P 500, was up 1.1% approximately from last Friday's close. Like last week, the index stayed generally within a fairly tight range between highest and lowest each day, and so implied volatility, as you'd expect in that sort of environment, was pretty low.
Great. And how are we in terms of the allocations within the portfolio this week?
Well, we were more active in the middle part of this week in terms of the level of allocation, at which point we reached perhaps 2/3 allocated, but most of the week we've been quite a lot lower than that.
Great, thanks. Adam, at this point, I'd also like to just add in that we are looking to introduce some allocations within the portfolios. So it's just a case of the clients would be able to see some metrics on that on a daily basis as well. Okay, right. How were the portfolios in terms of the risk managed this week?
Well, one issue we had to contend with this week was the equity market on aggregate moving in a narrow range, albeit upwards. And what that tends to mean is it's difficult to make much money through variable exposure to the overall market, which sometimes referred to as beta timing. But as the week has turned out, a buy and hold strategy consisting of the overall market would have actually fared quite well. But if a range-bound market on aggregate also contains range-bound sectors and range-bound stocks, and if there's a tight dispersion across them, then that can also limit attempts to add value through themes and stock picking. Unlike last week, we were not so starved of dispersion this week, but some of that dispersion and some of the stocks that took genuine direction rather than remaining in tight ranges were those that were reporting earnings. So, as a matter of policy, us staying away from investing in stocks that are reporting to avoid large shocks. That meant we couldn't participate very fully in some of those stocks that we might have otherwise wanted to be involved in. So in terms of where we did spend our risk budget, given the set of opportunities on offer, it was necessary to be very quick and opportunistic, finding where we could anomalous behavior at the stock level. It was not a fruitful week for writing options with the pricing and volatility so depressed. So the very great majority of activities was just on stocks directly.
Thank you, Adam. And what do we need to look forward to in the next week or so?
Well, as you know, we're some distance into the Q3 earnings season now, and next week's another quite big week for results being announced. After that, the schedule begins to thin out a little bit. Some strategists are they're starting to analyze and comment on the way that the earnings season has gone and the way that markets have reacted to it. And some have been suggesting that markets were perhaps underexposed to market risk, too pessimistic. So there's been an asymmetric response with good news being more strongly reacted to than bad news. I'm not so sure that's entirely true, or I'm not sure how robust that research is, but it's worth noting that amongst this period of various earning announcements, we have also seen, in fact today, the S&P 500 toying with new highs and not quite managing to make those new highs. So I think one of the very interesting things to watch as the weeks unfold is if any repeat attempts are made to break into that new territory on the upside, and if they're successful and sustained, that may open the door to some more upside and certainly some bullish write-ups from commentators. But as the earnings season passes its peak, I think the commentariat in general will become more occupied with the first prints of Q3 GDP coming out from amongst the major economies, as well as watching the Fed intently and other central banks for any hints that they feel they have or don't have more compelling reasons to add more stimulus. Plus, the various geopolitical stories continue onwards. We'll keep on making news stories, trade wars, Brexit, and the rest.
Okay, thank you, Adam, for that insightful update. Right, so before we wrap up, I just want to cover the important subject of some introductions of new portfolios to come. So we are looking at potentially introducing a futures-based portfolio. So that would be a much higher growth with potentially more traction in terms of the returns. We're just kind of trying to work out the risk management side of things for that portfolio. The other product we're looking at is the savings-based products. And so we'd be keen to open up discussions on the community forum about what your views are around the micro savings or other products out there. And it'd be nice to hear how we can merge the two products, so on the savings side as well as on the investment management side, and with the introduction of our futures-based portfolio as well. Okay, with that, brings us to the end of our podcast. Thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel and have a great weekend. We look forward to our next Friday's podcast. Take care.